Our job begins where most advisors stop. Saving money is great, but how do you spend it without risk in retirement? Welcome to Every Day is Saturday with Brad Gotto and Matt Stahl, partners and private wealth managers at Fiat Wealth Management. In this podcast, we aim to broaden your knowledge about the financial world we live in today and make the boring and complex financial decisions fun, informative, and educational. Join us on this journey where Brad and Matt will explore different strategies on how to spend your money without guilt and have peace of mind knowing you are spending it the optimal way in retirement.
All right. Hey, everybody, and welcome back to Every Day is Saturday. Matt, this is episode 11 already. Can you believe that?
Holy cow.
I know it went fast, but if you're listening to this episode and you have not yet listened to episode 10, today is actually part 2 of us pulling back the curtain on how advisors are paid. And we talked about this a little bit last time, Matt. This may get us kicked out of the good old boys club, letting everybody know exactly how we make money. But again, I'll just stress to the listeners, if you did not listen to episode 10, you're going to want to go back and start there, where we kind of pull back the curtain on the securities side of our industry. And we talked about pulling back the curtain on the insurance side. We teased a little bit, and today that's what we're going to do. So I'm excited to start this. But before we do that, Matt, what's new? Tell us something fun about yourself, or tell us a funny joke. You're a joke guy.
Yeah, let's stick with the joke. And we just threw this one out yesterday. So, what's the best part about living in Switzerland?
I have no idea.
I don't know, but the flag is a big plus.
And that's it for today's episode.
Thank you, everybody.
Just to recap before we get into it, Matt, I think it's worth mentioning again, even if they did listen to episode 10 and are listening to this on a back-to-back, I think one of the most confusing parts about our industry is the fact that, for all intents and purposes, a lot of advisors have multiple businesses, in essence, under the same roof. Last week, we talked about the obvious one, the fact that we manage money and how fee-based advisors are paid versus how commission-based advisors are paid. But also under that roof, as a matter of convenience for the clients, a lot of advisors also have other lines of business. And insurance, I would say, is probably the next most common one.
Yep.
And in our industry, Matt, that could be life insurance, that could be annuities, which are insurance products. That could be long-term care, disability, maybe a little bit less common, but definitely out there are advisors that also do like healthcare, or maybe even property casualty insurance. I've even seen advisors that are CPAs, and so they're actually filing taxes as well. And so, kind of depending on how the advisors are structured, there could be all different kinds of revenue sources or businesses essentially cobbled together for convenience matters for the client.
Yeah, absolutely. So last time, Brad, we started with the history, on the security side. We started with the history to kind of give some context, and then talked about some of the governing bodies, or who are the babysitters for keeping an eye on this stuff. So let's start there. And I consider you our resident in-house insurance expert. So I'm going to be asking the questions of you today.
Uh-oh.
Yeah. So be ready. So let's start with the history. What can you share with us just as far as history goes when it comes to this line of business?
Sure. I think that it's important to understand that when it comes to insurance, that insurance is regulated on a state by state basis. And so every state has their own kind of set of rules and regulations as it relates to insurance. And so that's important to note, because that's not the way that the financial industry is. It's regulated by the Securities and Exchange Commission, like we talked about in the last episode, or FINRA, which is also a national regulating body, or even the banking world, right? When you're dealing with your bank, that's all regulated on a national level. And so they're all abiding by kind of the same set of rules and standards. Whereas from an insurance standpoint, every state has their own set of regulations. Now, Matt, I don't know every state regulation in all 50 states, but my experience has been they're very similar, but there's definitely some nuance and some difference.
That's interesting. Is there any state out there that's vastly different from the rest of them?
Well, the one you and I live in tends to be a little bit different.
Yeah.
The state of Minnesota, we have a very conservative insurance commissioner and set of laws and rules. The other one that comes to mind is New York. New York kind of abides by its own set of rules, not just on the insurance side, but also on the securities side of the world. And I think that probably goes and stems all the way back to the fact that the stock exchange is there, but that has also affected the insurance side of things. The other ones that come to mind are out on the West Coast. Oregon sometimes has some funky rules around insurance, or California. But for the most part, like I said, Matt, the core kind of 90% of the regs are the same. Around the fringes, we might see some differences state to state.
Got it. So last time we talked about when we're on the security side, so we could be regulated by FINRA or the SEC or both.
Yeah.
Is it just the state of Minnesota, or is there a certain department? How does that all work?
Yeah, it's actually, there is no difference when it comes to insurance. It's not like the security side where, depending on how your license is structured, who oversees you could be a different body. That's not the case with insurance. You're overseen by the state in which that you live in. It doesn't mean you can't practice or sell insurance outside of the state that you live in. You can get a non-resident license.
Okay.
In fact, you can have that in all 50 states if you want to. You have to apply for it. You have to pay for it. But at the end of the day, you're regulated by the state in which you live.
And we also talked about getting a certification, taking an exam to be qualified to give that kind of advice.
Yeah.
Is that similar on the insurance side, or is that completely different?
It's similar in the fact that you have to be licensed to sell insurance. And so when you go take the test to become securities licensed, that doesn't allow you to sell insurance, because there's a whole separate set of exams and requirements that are needed to be insurance licensed, I say with air quotes. And so vice versa. If you're insurance licensed, it doesn't mean you're securities licensed. Again, they're two completely separate things. And so as an example of that, Matt, I think what we've done here at Fiat tells the tale. Behind the scenes, we've got Fiat Wealth Management. Everybody knows that name. That's kind of how we conduct businesses, is Fiat Wealth Management. But we technically have a whole separate LLC for the insurance side of our business, because although there's a lot of similarities, they are that different that I think that they constitute a whole entire separate business entity. So there is Fiat Insurance Services as well.
Let's cut to the chase here. Let's dig into, you mentioned some of the different types of insurance we typically run into in the financial planning process.
Yeah.
Let's just run down that list. Let's start with, we'll go in alphabetical order. Let's start with annuity. So we've dug in a little bit on what an annuity is, but tell us about, I come to see you, you're recommending an annuity to me. How do you get paid on that if I decide to move forward?
Well, I think one of the things that's important to note, Matt, is as we walk through these different types of insurances and talk a little bit about how advisors are paid or insurance agents are paid, that we talk about 2 points first that are going to be consistent across the board, no matter what product we're talking about. The first of which is that it's an insurance product, which means if you're insurance licensed only, you can still sell the majority of these products. So you don't have to have like Fiat Wealth Management to have Fiat Insurance Services. That's not required. You and I could just be running around selling insurance. That's important to note. There are some caveats to that, which I'll talk about as we talk through annuities and life insurance. But the other side of it is that across the board, it doesn't matter who you do business with, whether it's you buy a solution or a product through our firm, or you buy it through, John or Jane advisor down the street, or you try to buy it direct from the insurance company, you go online and you're doing your own shopping, that the product that you get is exactly the same, right? So if you're looking for, term life insurance as an example, or an annuity, as we're going to discuss, and you want ABC annuity, that product is what it is, no matter where you get it, right? And so it's not like going to one brokerage house over another firm or going direct is going to get you a better deal, so to speak. So I guess I just wanted to point that out. So people should just know that they're getting the same product. So now back to your original question of how do we get paid on annuities? The answer is it depends. So let me just give some examples, because there's all different types of annuities. And I like to use the analogy of like the word car is a very broad term. When people say I'm going car shopping or I need to buy a new car, that could mean they're buying a Ford F-350 dually pickup. It could mean they're buying a smart car, right? Or anything in between. And with annuities, it's kind of that way where there's everything from, standard fixed annuities that look and feel a lot like a CD at a bank, all the way to a variable annuity on the opposite end of the spectrum, which is a market-based product that has some insurance components to it. So it's similar to like a brokerage account that you have in money invested, but it's got some insurance components to it. And there's a lot in between there. So there's SPIAs, there's DIAs, there's fixed indexed, index variable, so on and so on and so on. And I know a lot of those terms don't mean anything to anybody, and that's not the point of me saying it. I just want people to understand there's a lot out there. And so the compensation to the advisor or to the insurance agent is going to be different based on the product. And a lot of them, not all of them, Matt, can be sold just by an insurance agent. You don't have to be a wealth manager as well. The exception to that is the annuities that have that securities component to it. So like I mentioned, variable annuities and how it's a market-based product.
Okay.
If there is a pure market component to it like that, and the money that you deposit in the annuity has any risk involved, like you could lose money in the annuity, then you do in fact have to have a securities license to be able to sell it. There are some annuities out there and they're all commission-based. Everything in the insurance world, Matt, is commission-based. And so, and the advisors or the insurance agents have the choice usually of how they want to collect that commission. The insurance companies allow for us to choose if we want all of the commission up front and never get paid again. So we get kind of a lump sum payout or commission, and then that's it. It's over. And then on the opposite end of that spectrum, Matt, there is what they call a trail-based commission, where you're paid out over time. And that trail could last 5 years, 10 years. Sometimes they're as long as the contract exists. And so if a client buys an annuity and they hold it for 30 years, it could be that you're getting paid out for that entire 30-year period. That complete trail-based, Matt, if you listen to episode 10, is very similar to fee-based advisors that are paid annually on the assets that they manage.
Yep.
And then there's in-between compensation where you get some of it up front and a smaller ongoing trail. So the advisors have a choice. They usually the language used is like A comp, B comp, or C comp. And every contract that you sell, you get a choice. Do I want A, B, or C on this one? And sometimes there's even more options than that. But to give you kind of a general rule of thumb, and I want the listeners to not take this, it's not always this way, right? But as a general rule of thumb, if you get into some of these more fixed products that are shorter term, I would say an average commission that I see is in that 2 to 4% range if the advisor takes it all up front.
So if I decide to move forward as a client with $100,000 annuity, you're making somewhere between $2,000 to $4,000
in that range for these shorter, more fixed type products. And shorter, Matt, is I'm talking about products that have time. All these products have time commitments.
Okay.
Well, not all of them. There's some exceptions to that too. Most of them have time commitments. And so, and that if you're buying annuities that kind of have that 2 to 5 year time commitment, and it's more of a fixed chassis, then it's going to be in that lower range. But of course, if we get into these longer annuities that are in that 7 to 10 year time commitment, and sometimes even longer, Matt, there's still annuities out there today. Not a lot. They're kind of dinosaurs, but there's still annuities out there today that have like 14-year time commitments to them.
Okay.
But I would say the average is 7 to 10 years, kind of on that longer term. And you're getting into more of the variable type or indexed type annuities, then the compensation is usually somewhere between that 5 and 7% range. So to go back to your example, client deposits $100,000 into one of these annuities. Should the advisor choose to take the compensation all up front, they're going to get paid $5,000 to $7,000 roughly.
So the reason for me being a client typically to look at an annuity is for some sort of guarantee that insurance company is going to give me, correct? So you're telling me no matter if I decide to move forward with a $100,000 annuity, you as the advisor, depending on how you choose to get paid, I'm going to see the same thing no matter what. And
that's correct.
Guarantee. Okay.
Yeah. The contract is not changed or altered in any way based on how the advisor chooses to get paid from the insurance company.
So with annuities, I think that you feel like there's anything else that is worth sharing when it comes to the annuity?
Well, I just think that the listeners that I want them to feel empowered to ask their insurance agent or their advisor how they're paid. Because I think that this is one of the areas that holds people back from making good financial decisions is they always have this kind of nagging thing in the back of their mind of, I don't really understand how they're paid. And I just wonder if they're making these recommendations in their own best interest, because I know they're getting compensated. I just don't know how they're getting compensated. And I don't know how their compensation relates to some of my other choices. Yep. And so if you're shopping something like an annuity, which is probably, let's just be honest, the most controversial product in our industry, that usually is something in the back of people's minds. And so again, don't take my numbers to, as that's always the way that it is. Cause like I said, there's always exceptions. I've seen contracts pay less than what we discussed. I've seen them pay more than what we discussed. I'm kind of playing that most case scenario because there's so many different products out there. It's hard to generalize like this, but yep. Generally speaking, those are the answers. And, you and I, just to give the listeners an example, there are times, Matt, where you and I take the ACOMP. We take the all up front. And then there's other cases where we're taking more of a trail-based compensation. Yep. Because that's just what fits better into our business and what we've got going on here at Fiat. And the good thing for us, quite frankly, is that it doesn't affect the client's product, right? It doesn't affect the outcome that they get. And so that's, I guess, kind of a nice part of that.
Let's move on to the next, what I would think is the next most common insurance product that we typically run into, and that would be life insurance. And life insurance can get really confusing. There's a lot of different types, just like you talked about with the annuities. So yep. Can you walk us through and just start off? What are the general types of life insurance and then dig into each of those?
Yeah. Matt, it's also interesting with life insurance because there's a lot of life insurance products that you only have to be insurance licensed to sell, but there are actually a couple of them where you do need a securities license to be able to offer them. Same thing that we discussed before with annuities. There are life insurance contracts that have an investment component to them. And that investment component offers the ability for your money to grow, but it also means that you could lose money. Your money's at risk. And anytime you put your money at risk, it requires a securities license. But even more broad-based than that, Matt, the two general types of life insurance are permanent and term. Okay. Term is exactly what it sounds like, and permanent is exactly what it sounds like. Permanent is meant to be forever until you pass away. Term is for a set period of time. And term is much more simple. So let's just start there. Okay. Term insurance can be, you kind of get to name your parameters of how long you want the term to be. I mean, what's typical, Matt, is 5, 10, 20. I've seen terms as long as 30 years. Then you get to name your death benefit, kind of what you want the policy to be or how big or small you want the policy to be. And then that, based on your health underwriting, is going to determine what your premiums are. Your premiums are what dictate how the advisor gets paid. Okay. Generally speaking, in life insurance, again, with the caveat that it's not always this way, but the more you're pumping into that life insurance every month or year, the more the advisor's getting paid. Because it really just, and there is a big gap between term insurance and permanent insurance. Advisors are paid a lot more to sell permanent insurance than they are, and insurance agents alike, than they are to sell term insurance, because it requires a lot more money to fund them. And they're typically a longer term deal. So with term insurance, Matt, as an example, if the client's putting $100 a month into their term policy to fund it, whatever the parameters of it are, that's $1,200 a year. Usually the compensation to the advisor or insurance agent has something to do with first year premium. So they kind of annualize whatever you're putting in the first year, and the advisor's getting paid some percentage of that. I've seen it as low as like 40% of first year premiums. So in my example of let's just say it's $1,000 a year are the premiums, they'll get paid $400 and then never get paid again on that contract. I've seen it as high as like 110% of first year premiums. And so in that example, they'd get paid $1,100 to sell that term policy. And I'm sure there's exceptions to that too. I'm sure there's certain situations where it's lower or higher. But at the end of the day, term insurance really is pretty simple, but it's all based on your first year premium. And I haven't seen a trail-based commission on term insurance, Matt. Doesn't mean it doesn't exist, but for the most part, that's kind of an upfront compensation based on what you're putting into the policy.
And same thing there. As a client, I'm getting the same policy, whether you're getting paid on that or I go find that myself.
100%. Yep.
Okay.
Yep. Absolutely. Permanent insurance is similar. I mean, the way that the advisor is paid is similar. It's based on premiums being put into the policy. And we could do a whole nother podcast on the different types of permanent life insurance, as well as permanent, not permanent, but with different types of annuities that I was alluding to earlier. So we'll save those conversations for a different day because we're really trying to focus on the compensation side. But when you get into permanent insurance, whether it's a universal life chassis, variable universal life chassis, index universal life chassis, your whole life, again, the compensation to the advisor is going to be based on how much money you're putting into the policy. Okay. And they have what they call target premiums. And to be honest with you, Matt, I've never really understood it all that well of what they deem your target premium should be. Because in permanent insurance, clients do need to understand that part of their money goes to pay for the cost of the insurance that they're buying. And part of their money is going to build a savings account inside of the product. And so the insurance companies kind of have like a set target of what how they think you should fund the contract for the contract to be healthy.
Okay.
And so your commissions are going to be based on that target. Doesn't mean that's how the client is actually funding the contract. They could be putting more money into it than that. And so for purposes of trying to use it down the line for kids' education or retirement or what have you, but the compensation is based on that target premium. And just like term insurance, I've seen compensation as low as 40% of target and as high as probably 110 or 120% of that target premium. But obviously premiums in permanent life insurance are much larger than they are in term insurance because it's permanent versus for a set period of time.
Okay.
And so typically advisors get paid significantly more to sell permanent insurance than they do term insurance. And again, I'm speaking in generalities.
So that covers the two biggest areas, I would think. We also have long-term care, disability insurance. Is everything pretty consistent across?
Yeah, when you get into DI or disability insurance and long-term care, or even long-term care hybrid policies, which are a lot more popular these days than just traditional long-term care policies, it really is premium-based, just like life insurance, where the compensation to the advisor is going to be disability, I'd say on average is about 85% of first-year premiums. 50 to 85%, somewhere in that first year premiums that you're paying is what they're going to get compensated. And then long-term care, traditional long-term care, Matt, it's been so long since we've sold a traditional policy that I think I'd be lying to our listeners if I even tried to guess where it's at these days. I think it's similar to DI, but I guess don't quote me on that. But I do know it's tied to first year premiums as well. And then the hybrid policies that have like a life insurance component to them and a long-term care component to them are paid just like life insurance is paid.
That might be an interesting conversation for a future episode. Why in the heck have you not recommended a long-term care insurance policy?
Yeah, we do recommend the coverage. It's just usually more efficient these days to do it in a hybrid fashion than it is.
Yeah.
Same with cars, Matt. We're just going the way that the cars are going.
There we go. That's right. Right. Any other questions that you feel like I should have asked you or that you'd like to share?
I don't know about questions, Matt. I think it's just more the point. And the reason that you and I felt like this was worth an entire 2 episodes of a podcast is that you and I aren't shy about the fact that we're paid. You and I aren't shy about the fact that we're not a 501c3 nonprofit organization. We are a for-profit organization, and that's okay. And I think we should be compensated for what we do. But our industry, for whatever reason, just hasn't done a really good job of disclosing exactly how we're paid. And I'm one of those people, Matt, that I just like to know. I'm okay paying my plumber. I'm okay paying my doctor, my lawyer, or whatever other professional I have in my life.
Yeah.
I just want to know, what am I paying for?
Yep.
And if I can get comfortable with the idea of what I'm paying for and why, then it shouldn't be an issue. I think the only real reason to try to hide it is because you think there's a lack of value. advisors or insurance agents are sheepish about what they're paid because they think it's too much because they're not providing enough value to their prospective clients. But I just think it's important that people understand. And I also think if you're a client of our firm and you're listening to these episodes, or you're a prospective client of our firm and you've been, engaged with us or in any capacity, but not yet chose to become a client, that 100%, Matt, these are questions that you can ask us, and we're just going to tell you. I tell people that a lot, but I'm sure I've missed some people over the years alluding to that. But whatever solution that we put in front of a client that we think is in their best interest because of our fiduciary capacity, there's no reason the client shouldn't be able to know exactly how we're compensated.
Yeah, I agree. I feel good. I feel like we covered it.
Absolutely. We don't need to beat the dead horse, so to speak, on exactly how we're paid. But I would encourage people to, if they have future questions or they have any specifics, if they're thinking, gosh, Brad, Matt, you talked a lot in generalities because we kind of had to, but they have specific questions about products, or maybe they were recommended a product by a different insurance agent or advisor, and they want us to kind of look into it and help them understand how they were paid. I don't know about you, Matt, but I'd be more than happy to do that. As always, guys, thanks so much for listening to Every Day is Saturday. If you want to reach out to Matt or I or anybody at Fiat, our website is going to be the best place to go. It's going to provide you all of the information you need. That website is www.fiatwm.com. Also, please subscribe to the podcast if you have not done so already, because we don't want you to miss an episode. And we would love it if you would share it with your friends and your loved ones. As always, guys, I'm Brad Gotto.
I'm Matt Stahl.
And we'll see you guys next Saturday.
But Brad, we don't record the podcast on Saturday.
It's episode 11, Matt. How many times do I got to tell you? Every day is Saturday.
Aha.
Thank you for listening to Every Day is Saturday. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Fiat Wealth Management or Foundation's investment advisors. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.